Money that sits completely idle inevitably decays. Inflation chips away at its purchasing power, turning stored wealth into dead capital over time. To prevent this decay, investors turn to the absolute foundation of the financial system: cash deposits and money market accounts. By depositing wealth into a bank, that capital is actively deployed as short-term loans to governments and institutions, earning a modest interest rate in exchange for minimal risk. This chart illustrates the annual equivalent rate, or AER. It tracks the actual return on a cash deposit by factoring in the stated interest rate and, crucially, how often that interest is paid out over the year. The lower trajectory here is a simple nominal rate. The curve steepens for the AER because it accounts for compounding, the mathematical advantage of earning interest on the interest you have already accumulated. Cash markets have hard limits. During severe economic downturns, central banks can drop policy rates below zero. Under negative interest rates, depositors effectively pay a fee to keep their money in the bank. The system intentionally penalizes hoarding to force capital out into the active economy. When the cost of total safety becomes a guaranteed mathematical loss, capital has to move. Investors must leave the security of cash and navigate the complex, riskier architecture of global financial markets to secure a real return. When a corporation or government needs to build a factory or fund infrastructure, they can issue a bond. This is a formalized loan from the investing public, where the issuer promises to pay regular interest and return the original borrowed principal on a specific maturity date. This visualization compares two ways to measure that bond's return. The first model is the flat yield, which strictly measures the annual interest payout relative to the bond's current market price. The second model calculates the gross redemption yield. It factors in those annual payouts, plus the final capital gain or loss an investor realizes when the bond is finally redeemed at its nominal value. Because a bond is only as good as the promise to repay it, independent agencies like Moody's, S&P, and Fitch evaluate the issuer. They analyze the debtor's financials and assign credit ratings that quantify the exact probability of default, grading them from secure investment grade down to highly speculative junk status. Equities, or ordinary shares, operate on a completely different premise. Instead of lending money, shareholders buy a slice of the company's actual ownership. If the company is liquidated, shareholders are paid last. They absorb the maximum risk, but in return, they secure voting rights and capture corporate profits through dividends and capital growth. This pie chart demonstrates a rights issue. When a company issues new shares to raise capital, the law often requires them to offer those shares to existing shareholders first. If you own 20%, you're offered 20% of new shares, maintaining your exact slice. But if you waive that right and third parties buy, total shares increase while your holding stays flat. Your slice shrinks, mathematically diluting your ownership. Capital markets cleanly divide participants into two camps: lenders who accept capped upside in exchange for fixed promises, and owners who accept total exposure for the chance at unbounded growth. Beyond simple ownership, markets offer derivatives like options. A call option gives an investor the right, but no obligation, to buy an asset at a predetermined price. A put option gives them the right to sell it at a set price. The value of these contracts hinges on a strict mathematical threshold. If the current market price moves favorably past the agreed strike price, the option is in the money and can be exercised for a profit. If the market moves the wrong way, it is out of the money, and the buyer lets the contract expire, losing only the premium they paid up front. This principle of pricing risk extends to modern digital assets. Cryptocurrencies float entirely on decentralized supply and demand, making them highly volatile. Stablecoins attempt to solve this volatility by pegging their value directly to traditional reserves, like fiat currency or commodities. Central bank digital currencies act as the state-regulated counterpoint. Instead of relying on a decentralized network, a CBDC is issued and tracked directly by a central bank, digitizing local currency with strict regulatory oversight. Whether an investor is trading an agricultural futures contract or a cryptographic token, the ultimate function of the market remains identical. It is a mechanism to isolate, price, and transfer risk. For decades, the transfer of risk looked exactly like this. Buyers and sellers crammed onto physical exchange floors, matching trades through shouting and manual negotiation. Today, most global exchanges operate as order-driven markets. This diagram illustrates an electronic order book. Buyers and sellers submit their desired prices into a strict chronological queue. When a buyer's maximum price finally overlaps with a seller's minimum price, the system executes the trade automatically. Quote-driven markets rely instead on intermediaries called market makers. Rather than waiting for a natural buyer and seller to find each other, market makers continuously broadcast both a buying price and a selling price. They guarantee liquidity, standing ready to trade under all market conditions and extracting a profit from the spread between their bids and asks. Retail investors navigate these systems through brokers. Under regulatory standards, a broker acts as an agent required to achieve best execution. They must route their client's order through the market to secure the optimal combination of price, speed, and settlement reliability. These rules dictate how easily assets convert to cash. By ensuring continuous liquidity, these trading systems prevent the global flow of capital from freezing up. Once a trade is struck, the actual transfer of ownership takes place entirely behind the scenes. Holding a physical paper certificate to prove ownership is incredibly rare today. Modern shares are dematerialized, existing entirely as book entry electronic records, updated on secure databases. The transaction enters a phase called clearing. This establishes the exact legal obligations of both parties. To eliminate the risk of one party defaulting before the cash and shares swap hands, markets rely on central counterparties, or CCPs. This graphic illustrates a process called novation. Instead of the buyer and seller relying on each other, the CCP steps directly between them. The central counterparty legally becomes the buyer to every seller and the seller to every buyer. If one trading firm goes bankrupt and fails to deliver their shares, the CCP absorbs the hit using its own collateral. The default is completely isolated, protecting the counterparty and preventing a cascade of failures across the wider network. The final step is settlement, executed via delivery versus payment. The system verifies that both the cash and the assets are present and exchanges them simultaneously. In most major equity markets, this final settlement occurs on a T+2 basis, meaning the actual transfer happens exactly 2 business days after the trade is agreed. Capital markets process trillions of dollars every day between participants who do not know each other. The global economy scales to this massive size not because of the assets themselves, but because this invisible, rigid machinery mathematically enforces trust.